over to you.
Thanks. Thanks, Flobella, and thank you, Eugene and BCI. Always great to be here. Okay, this morning, Chantal spoke about imagery and how much imagery we see within a certain period of time. And my neuroscientist friends tell me that a human can recognize a face in less than 1/10 of a second. And I think it's 1.7 of a second, you can recognize a familiar face. And, you know, forgive me for putting up a bit of a grotesque picture as my title page, and you've probably been looking at this, trying to figure out what that is, and trying to see faces in that picture. But it's really a sculpture by at the Wallenstein Palace in Prague, done by a few artists quite a few years ago. And it's called a dripstone wall. It was purposely made like this so that people can try and figure out what they're trying to see. It's our brain. And this is a phenomenon known as pareidolia, where it's a psychological phenomenon where the brain perceives familiar patterns, and then most commonly faces in a random and vague or inanimate object. So, in other words, you try and see something. I mean, that's a tree, and that's just, you know, the knots on the tree, but it looks like a face. And it got me thinking about the current world that we are in at the moment, especially on the fixed income side. We're dealing with complex and noisy data at the moment, lots of noise. And, you know, I heard early on yesterday, I heard about uncertainty. Today I heard that word uncertainty being used countless times in people's presentations, even verbally as well. But there's lots of macro signals, the geopolitical tensions I don't have to mention, central bank rhetoric and languages, and of course inflation, yield curves, and credit spreads. Now this gives, or creates a lot of room for pareidolia type or pareidolia-like mistakes. Because what are we actually looking at? And what are we actually seeing? What faces are we actually seeing? What is our brain actually trying to achieve? You know, and I think our mind or our brains are wired to find patterns, even when they don't exist. And common ones is false pattern recognition. So we see yield curve movements, but these can be very coincidental. So you have a twist or a shift or a butterfly, and can be very coincidental, but then we try and make an inference from that, and hopefully not an important investment decision, because it can be quite critical. You know, you can overinterpret market signals. So you assign meaning to noise, and there's a lot of noise at the moment, a lot of rhetoric happening in the macro environment, and you assign an investment decision just because of that market signal. And the narrative that we're seeing, for example, coming out of central bankers or out of analysts saying a recession is coming, is that really the case? Are we just seeing a face, or is a recession really coming? I think we have to be quite sharp about that. And then, you know, this curve-shaped misinterpretation as well. So, you know, not every inversion means that we're going to get a recession. You know, let's be careful about that. And then, my apologies to the mathematicians, but backtesting can provide illusions as well. If you don't have a big enough sample size and you find a pattern in a small sample size, that becomes the reality. Let's be very careful about that. And there's a couple examples where we've had this pareidolia type of mistakes happening. You know, the one I can think of is the false recession signal in 2019. And yes, myself and Johnny were discussing early on how long we've been in this game, and we remember bonds from way back when, but yeah, we've been around in 2019, so we've seen a yield curve inversion, and everybody was predicting a recession. And did it really come about? You know, I think we did have a recession, but not because of the yield curve inversion. It was more because of COVID, and COVID actually caused the steeper yields and the recession to occur. And then we had the taper tantrum, which was misread in 2013. We had the slowdown in the purchase of bond yields, and everybody was saying, well, that's going to spike bond yields, and it's going to carry on forever. It lasted for a short while, and then we were back to stronger yields very, very shortly after that. Third one is, do we remember this term, inflation is transitory in 2021? It's just going to be there for a short period of time. And what happened? Inflation actually stayed along with us for a much longer period. So I think the important thing here that I'm trying to say is, let's be careful about the way in which we interpret signals within in the market. And let's be careful about the way in which we group those signals or use single signals to interpret what we do. So now, for example, oil and energy is very topical. So oil is predicting hills. Is it really? I'm sure it is, but only to a degree. I think we've got to be much more holistic about the way in which we think about things, because does currencies predict bonds? I've heard people say, oh, just tell me where the rand is going, I'll tell you where bonds are going. So, you know, we've got to be careful at the way we actually do these things. And, or does certain business cycle indicators tell you where rates are going to be? My point is here, things have to be holistic. You've got to look at things in a very holistic fashion. And once your process, your investment process looks at things in a holistic fashion, then you can actually be a bit more comfortable in the way in which you make investment decisions. You know, I heard the word uncertainty. Yesterday I saw a presentation on uncertainty. Today I saw it being used, or a derivative thereof, or a variant thereof, being used countless and countless times. Uncertainty spiked. This is a world uncertainty index that counts the number of times the word uncertainty is used in certain economic publications. And in 2025 already the world was feeling rather uncertain. It peaked now at the beginning of this year with the Middle Eastern tensions, and then it came back again because we were uncertain what the war is going to do, but now at least we know there is, or at least what the tensions are going to do. At least we know it's there, and we can move on. The important thing is there's a lot of uncertainty at the moment. And then something I showed last year is, besides uncertainty in our investment environment, people were feeling very fearful about a little bit more than a year ago. Now suddenly there's greed. This is the CNN Fear and Greed Index. Strange. Okay, granted, the way in which this index is constructed is largely from parameters from the US markets. But now we have this antithesis, or this irony, that we got all this uncertainty, but we're still greedy as well. We want to get in on the action. But I kind of sense that coming through in a lot of the presentations. So what I'm going to very quickly do is look at certain of the factors that are presenting themselves right now, where are we right now, and how we can actually approach it in terms of the fixed income environment. So globally, we know growth. We've had downward revisions. It's looking relatively stable. I'm talking about global growth now. But it's also divergent in terms of the economy which you are in, whether you are in an emerging economy or whether you are in a developed economy. And then, of course, there's global inflation. A lot has been spoken about global inflation this morning. We're all uncertain as to how, and myself and Brandon were talking about how embedded inflation is going to happen post this oil supply shock. The important thing is that a lot of the world still depends on fossil fuels. I know a lot of us have been spoken about new technology, but there's still a lot of dependence on it. And I think we've got to be cognizant about the fact that there will be second-round effects, embedded effects. Obviously, the timing and how long it's actually going to take to get there and the extent is the big question. And then, of course, monetary policy. I think central bankers across the world have got to be very, very vigilant in the way in which monetary policy gets applied. I think those are, in my mind, the three global themes that's driving rates at the moment. There's many other things. So let's not just find the face in one thing, but let's look at the global monetary policy, the global growth, and the global inflation together. And then locally, our growth. A lot has been spoken about the positive things that has happened in our economy, and I agree with that. You know, such as we haven't had blackouts and Transnet and coming off the grey list and the like, but our unemployment is still high, and we need to get business confidence up there as well. So growth, yes, stabilization, but there's still a few areas we need to work on. And then our local inflation expectations are critical to the outlook, I think, because obviously inflation is embedded in your yields, and it's expected inflation that gets embedded in your bond yields. As I think it was Chantal that said earlier on, things are going to get more expensive, and they definitely are, and we're going to see that coming through in our bond yields as well. And monetary policy from a local perspective, I know that the SARB has been quite, and Lesotho in particular, has been quite emphatic about the fact that it'd rather err on the upside, or hiking rates, than to cut rates too soon. So watch out for this. We're going to have a Monetary Policy Committee meeting soon. Our currency is also a factor that drives. Our currency is so liquid, traded anywhere, and it drives rates as well, depending more on global factors than local factors. I think it's an important factor to watch. So, where does this all put us in terms of actually seeing what is out there? What is actually happening? Because we have to position ourselves. We have to construct a portfolio. That's our job as portfolio managers. We have to construct it according to a mandate. We have to deliver on that mandate. We need to beat a benchmark. And I think this audience in the room largely wants you to be number one. You've got to beat your competitors out there. You mustn't lose any money, and you've got to beat your benchmark. So it's an easy job for us. Yeah, simple. But, I think in terms of the yield curve, definitely think there's still value in the curve, depending where you can position yourself. Bonds, definitely there's value, and all the speakers have spoken about how we can actually get value and break down the embedded value within bonds. I think monetary policy has peaked for now. I don't think we're going to see rate cuts locally. So there's definitely opportunity in the bond market. Where we stand at the moment, and this picture I'm showing you right now is our conviction as Cadiz, because I mentioned a few elements or a few factors that drive interest rates. My message is that don't just look at one factor, and the dominating factor at the moment is the supply shock as far as oil is concerned. I've heard it being called a pothole. I've heard it being called various other temporary as another word. So be careful of getting hung up on one particular hot button. At the moment, our conviction says be cautious from a duration perspective. In other words, sensitivity perspective. But don't get me wrong, we're fully invested in the bond market because we do see the value that can come from it. So, two of our funds that shows this is our Enhanced Income Fund. I'm not going to go through it, but please, on your own accord, have a look at our funds. This kind of thinking that I've been speaking about today proliferates in the funds, and they most certainly have low variability of returns and still provide the returns that they are aiming for, as well as our absolute yield fund that takes a bit more risk as far as bonds is concerned. So let me finish off by saying that the biggest risk isn't just being wrong. We're all scared of being wrong. I heard about the question was asked earlier and by that gentleman in the back about what is your risk drivers. And, we can define risk in different ways, but it's not just being wrong, it's being confidently wrong because a pattern actually looks real. Look through those, do your homework, look through all of those things before you make your decisions. Thank you.